Are you tired of market predictions that never seem to come true? Well, you're in luck because today we're discussing the predictions of Michael Hartnett, the chief investment strategist at Bank of America, who has been sounding the alarm on the economy and financial markets for several months now. But Hartnett's predictions aren't just based on speculation and guesswork. In the past, he has accurately predicted economic downturns and market volatility, including the global recession of 2019 and the market downturn at the start of the COVID-19 pandemic. So, let's dive into Hartnett's latest predictions and analysis to see what he has to say about the state of the economy and financial markets, and what advice he has for investors looking to position their portfolios for success. Michael Hartnett, the chief investment strategist at Bank of America, has been sounding the alarm on the economy and financial markets for several months now. With rising inflation, slowing growth, and geopolitical risks, Hartnett warns that investors need to be cautious and prepare for potential market downturns. But what exactly are his predictions and advice, and what do other experts have to say? The COVID-19 pandemic has significantly impacted the global economy and financial markets, and recovery has been slow and uneven. Against this backdrop, Hartnett has been warning about potential market volatility for some time now. The VIX, a widely used measure of market volatility, has been trending upwards, suggesting that investors are becoming more nervous about the outlook for the economy and financial markets. Hartnett has also predicted that the S&P 500, one of the most widely watched stock market indexes, will drop to 3,800 before rebounding later in the year. Hartnett has been particularly concerned about the impact of inflation on the economy and financial markets. Inflation has been on the rise, putting pressure on the Federal Reserve to raise interest rates. This could in turn cause a market downturn or recession. The yield on the 10-year Treasury bond is an important indicator of interest rates in the economy. As the yield on the bond goes up, it means that the market is demanding higher interest rates on loans and other forms of credit. This is because investors are willing to pay more for the bond to get a higher return on their investment. When interest rates rise, it can have a significant impact on the economy and financial markets. It can lead to higher borrowing costs for consumers and businesses, which can slow down economic growth and reduce the profitability of certain industries. Hartnett's comments on rising interest rates likely refer to his expectation that interest rates will increase in the near future, which could have implications for investors and the broader economy. One way to track expectations for future interest rate hikes is by looking at the yield on the 10-year Treasury bond. This yield has been rising in recent months, suggesting that investors expect the Federal Reserve to tighten monetary policy. This could have significant implications for the economy and financial markets, as it could increase borrowing costs for businesses and individuals. While some experts have criticized Hartnett's predictions as overly bearish, others agree that investors need to be cautious in the current environment. One analyst quoted on Bloomberg TV noted that the market is currently priced for perfection and that any negative news could trigger a significant sell-off. Regarding diversification, Hartnett suggested that investors should reduce their exposure to high-growth equities and focus on value companies with less debt. He also recommended moving away from higher-risk fixed-income products and into safer investments. Hartnett suggested that investors should consider hard assets such as real estate, gold, and oil, but he warned that these investments are volatile and speculative. Hartnett also discussed the importance of cash holdings in a portfolio, saying that investors should keep a sufficient amount of cash on hand to take advantage of opportunities that arise in the market. However, he cautioned against holding too much cash, as it can erode the value of a portfolio over time. Overall, Hartnett emphasized the importance of being flexible and adaptive in a rapidly changing market environment. This can help protect against potential market downturns and allow investors to take advantage of buying opportunities when they arise. Additionally, Hartnett has warned about the potential impact of rising interest rates on the stock market. He has advised investors to stay away from risky assets and instead focus on defensive positions in sectors such as utilities, consumer staples, and healthcare, which tend to be less sensitive to interest rate changes and market volatility. After analyzing the state of the economy and financial markets, it's time to take a closer look at Michael Hartnett's predictions and recommendations for investors in the financial markets. As the chief investment strategist at Bank of America, Hartnett has been closely monitoring the markets and warning investors of potential risks, particularly in light of rising inflation and geopolitical tensions. In this section, we'll explore Hartnett's analysis of the financial markets and his recommendations for investors looking to position their portfolios in 2023. According to Hartnett, a hard economic landing could be coming, which could have serious consequences for financial markets. He predicts that a hard landing would likely be caused by a combination of rising inflation, slowing growth, and tightening monetary policy. So, what should investors do to prepare for potential market downturns? Hartnett has been warning about the potential impact of the Federal Reserve's tightening cycles on the stock market. He notes that every tightening cycle in the past has led to some sort of market correction or economic downturn, and he predicts that the current tightening cycle will be no different. The impact of inflation on the stock market is also a major concern for Hartnett. He warned that if inflation continues to rise, it could lead to a market downturn, particularly if the Federal Reserve is forced to raise interest rates more quickly than anticipated. To hedge against inflation, Hartnett recommends investing in inflation-protected assets like commodities and real estate. He also recommends diversifying across different geographies and sectors to spread out risk. Finally, he recommends staying away from sectors that are vulnerable to a market downturn, like technology and growth stocks. While these strategies can help investors prepare for potential market downturns, it's important to keep in mind that investing always comes with risk. It's important to approach investing with a well-rounded perspective, taking into account not only Hartnett's predictions, but also other relevant factors such as market trends, company performance, and global events. Having examined Michael Hartnett's insights on the economy and financial markets, it's important to take a closer look at his advice for investors looking to position their portfolios for success. As the market environment becomes more uncertain, it's crucial for investors to have a solid plan in place. We'll explore Hartnett's top suggestions for portfolio positioning and how investors can mitigate risk and take advantage of potential opportunities. In addition to his predictions and recommendations for the economy and financial markets, Michael Hartnett also has some specific advice for investors on how to position their portfolios. Hartnett also suggests reducing exposure to technology stocks, which have been a major driver of the market's gains but are vulnerable to regulatory crackdowns and rising interest rates. Instead, investors should focus on value stocks and companies with strong balance sheets that can weather economic downturns. Another key recommendation from Hartnett is to diversify globally, including emerging markets, to reduce risk and take advantage of growth opportunities. This can help investors balance out potential losses in one market with gains in another. Finally, Hartnett advises investors to be prepared for potential risks such as supply chain disruptions, geopolitical tensions, and the possibility of a hard landing in China's economy. By staying disciplined and avoiding making emotional decisions based on short-term market fluctuations, investors can position themselves for long-term success. With Michael Hartnett's insights and recommendations, investors can be better equipped to navigate the challenges and opportunities presented by the current economic and financial landscape. By staying informed, diversifying their portfolios, and taking a long-term approach, investors can position themselves for success in any market environment. By staying informed, maintaining a diversified mix of assets, and preparing for potential market volatility, investors can position themselves for long-term success. However, it's important to approach investing with a well-rounded perspective. Ultimately, by following Hartnett's recommendations and keeping a long-term outlook, investors can weather potential market volatility and take advantage of opportunities for growth.